Welcome to the deep dive. Today, our mission is to cut through the noise and, well, really unlock the foundational choices that define every great investment strategy.
Exactly. We're not just looking at where to put your money. We're looking at the core languages of wealth.
The five major asset classes, what they are, how they behave, and, crucially, how they should work together.
That's right.
Mhm.
We've gathered sources that break these down into distinct financial vehicles. Each one serves a unique function in a healthy portfolio, from growth to stability.
And there's this central concept unifying everything we looked at today that I think is just brilliant.
What's that?
Every asset class is a language. The good investor is multilingual. I mean, that captures it perfectly, right? You can't just rely on one dialect.
A powerful metaphor.
Mm.
And before we get too deep into these languages, we have to do our quick but necessary check from the sources.
The disclaimer.
Yep. This deep dive is purely educational. We're distilling information for you, but it is absolutely not personalized investment advice. Any decision has to come from your own research, tailored to you.
Absolutely. Think of us as your translators for the day. Okay, let's unpack this. Let's start speaking these five languages, starting with Group 1, the heavy hitters.
The ones that drive growth and also provide stability.
Exactly. So where do we begin?
We begin with the engine room of the modern portfolio, equities, what most people just call stocks.
Right. This is the idea of owning a piece of a business, a tiny fraction. Whether you buy shares in, a huge global company like Apple or you do it through an ETF.
You become a part owner.
Yeah.
And what defines stocks is their profile for long-term compounding. Our sources are all clear on this. It's the asset class with the highest potential for building wealth over decades.
You get the capital appreciation, the stock price going up.
And potentially dividends paid out from company profits.
Okay, but here's where it gets really interesting because the cost of that high reward is significant volatility.
Oh, absolutely.
We're talking about swings that can see your portfolio drop 30, maybe even 50% during a major crisis.
Correct. That volatility is, it's the price of admission. The only real way to smooth out those aggressive fluctuations, as all the sources detail, is a long-term commitment.
So you need time on your side.
You really do. Equities are designed for a time horizon of 10 years or more. If you're building wealth for retirement decades from now, this language of high growth, despite its choppy grammar, has to be central to your strategy.
That sets the stage perfectly for our second language, which is so often used to counterbalance those wild swings.
Stabilizer.
Bonds or fixed income.
Yeah.
This is switching to the lender's perspective.
Right. So stocks mean owning a piece of the company. Bonds mean you are lending money to a state or a company.
And in return?
In exchange, you get regular interest payments. They call it the coupon.
Mm.
And the promise you'll get your original capital back at maturity.
Okay, so the pros are pretty clear. Regular, predictable income. And much lower volatility compared to stocks. It's an essential balancing tool. But let me challenge this a bit. In an environment where inflation is, say, 5%, and a bond is only paying 3%,
Right.
aren't you just guaranteed to lose purchasing power? What makes them useful now?
That is a fantastic question, and it speaks directly to the critical detail here. Their sensitivity to inflation and interest rates.
Okay, let's unpack that mechanism a little.
Certainly. When the central bank, like the Fed or the ECB, hikes rates, the market demands higher yields on new bonds.
Which makes sense.
And as a result, your older bonds, the ones issued at lower interest rates, suddenly become less attractive. Their market price drops.
So you could lose money if you have to sell early.
Exactly. You're protected if you hold to maturity.
Mm-hmm.
But you have to understand that inflation risk is real. They're for stabilizing risk, not really for maximizing growth anymore.
Okay, that's a key distinction. Let's move on to the third language in this first group. Commodities.
The tangible stuff.
Yeah, we're talking about resources like copper, energy like oil and gas, and of course precious metals like gold and silver.
And you're usually not buying physical barrels of oil, of course.
I would hope not.
You're accessing them indirectly, often through specialized ETFs or maybe shares of mining companies. But what's fascinating is their unique function. They are a diversification cornerstone.
Why is that? Because they're often decoupled from the stock market, right?
Structurally decoupled. When the economy tanks and stocks are plummeting, something like gold might actually rise because it's seen as a safe haven, a store of value.
So it's like insurance.
It's very much like portfolio insurance. And critically, it offers strong protection against inflation. If the value of paper money is eroding, the value of the materials needed to build the world, copper, lumber, oil, that has to rise.
They're tangible, but the drawback is the yield, or the lack of yield.
Big one. Unlike stocks or bonds, there's little to no passive income. Gold doesn't pay you a dividend. And they are notoriously cyclical.
Highly cyclical. I mean, you just have to look at a price chart for crude oil. You see these years of a huge boom, then a dramatic steep fall.
Exactly. So this is an asset class best used as a controlled percentage of your portfolio, specifically to reduce that big picture systemic risk.
Okay, so we've covered the growth engines, the stabilizers, and the diversifiers. Let's get into group 2 now. These are the more specialized asset classes.
The ones with distinct challenges and rewards. We start with investing in stone, real estate.
Or, as our sources call it, immobilier.
Real estate has a few different access points. You can buy a physical property to rent out, which is very hands-on.
Lots of management.
Or you can go indirect, which is often preferred for a portfolio.
And indirectly means things like real estate investment trusts or REITs. You can buy and sell those easily through ETFs.
Right, but our sources also highlight another vehicle, especially in Europe, the SEPI, or non-traded property funds. And there's an interesting preference here.
What's the thinking?
Well, REITs are liquid, but they often behave a little too much like stocks. They can mirror the volatility of the equity market. These non-traded funds are considered closer to the stability of physical real estate.
And the main advantage there is what? Passive income.
That's the main draw, a potentially regular income stream from rents, and it's quite resilient against inflation. It gives you a solid link to the real economy.
But the main friction point here, the big one, has to be liquidity. If I put money into one of those funds, I can't just click a button and sell it tomorrow.
That is the major trade-off, illiquidity. It can take weeks, sometimes months to exit, especially in a downturn. And you also face high fees, entry, management, and exit fees.
And the sources mentioned a specific warning about taxes.
Indeed. The income from some of these can face automatic taxation, which complicates your final net return. So this is fantastic for income seekers who accept that they're locking up their capital for a while.
All right, finally, we get to the newest, most volatile language on the block.
The Wild West.
Digital assets or crypto. We're talking Bitcoin, Ethereum. High potential, but extremely high risk.
This is the realm of controlled speculation. The sources highlight, yes, significant growth potential and high liquidity. The original idea was that they were totally decoupled from traditional markets.
Which turned out to be not quite true.
Not entirely, no. While they are decoupled from a central authority, the sources note that crypto prices are still pretty correlated with major tech stocks. They tend to rise and fall with the general risk appetite in the market.
So the diversification benefit is there, but it's not absolute insulation. And that risk spectrum is just, it's terrifyingly wide.
Extreme volatility is the main feature. Price swings of 10, 20% in a single day are common. Regulation is still a huge question mark, and the risk of total loss on smaller projects is very, very real.
This is not the place for your emergency fund.
Definitely not. Now, the sources offered a really interesting insight on access and taxation, which is vital here.
Right, ETFs versus direct purchase.
Exactly. If you buy a crypto ETF, it's in a standard brokerage account. When you sell for a gain, that gain is taxed immediately.
But buying directly through a broker like Coinbase or Binance, that works differently.
Precisely. If you buy the crypto directly, tax is only due when you sell it for fiat currency, dollars or euros, and pull the money out. If you just trade one crypto for another, the tax event is typically deferred.
That's a huge difference. So this asset class is strictly for those who accept serious risk and want to add a small, controlled, speculative slice to their portfolio.
A very small slice.
Okay. We've covered all 5 of these distinct financial languages. Let's connect the dots now, because the real insight is in the translation. How do these combine into a coherent strategy for you, the listener?
Right. Let's look at the roles again. Stocks are your high-powered, high-risk engine for long-term growth.
Bonds are the suspension and brakes, stability.
Real estate offers that steady passive income, but it's not liquid. Commodities are your insurance policy against inflation and those black swan events.
And cryptos are pure speculation, high risk for high potential reward.
It's all about how you blend them. If you're a younger investor, say 30 years old, your portfolio should speak the language of growth fluently. That means a high concentration in equities. Your time horizon can absorb the drops.
But if you're approaching retirement, maybe 60, you have to shift your language. You have to prioritize stability and income.
A huge shift. That means a much bigger allocation to bonds, stable real estate, things that preserve your capital, even if the long-term growth is lower.
It's about designing the conversation to match your life stage. It reminds me of that simple reflection from one of the sources.
I think I know the one you mean.
Actions are for long-term yield, commodities for diversification, bonds don't bring much in growth, real estate is cyclical, and a little crypto is good, too much is dangerous.
That really does sum up the practical wisdom perfectly. Every class has its role, and you have to combine them based on your personal profile, your age, goals, and your tolerance for turbulence. That's what makes you a truly multilingual investor.
Okay, before we wrap up, we have to do the full formal reminder.
We do.
Huh.
Please remember, this entire discussion is educational. It is not personal investment advice. Any decision to buy, sell, or hold an asset must be based on your own exhaustive research, taking into account your situation, your objectives, and your risk tolerance.
And past performance is no guarantee of future results. The risk of loss always exists.
Always.
All right. Now that you have the vocabulary of these 5 languages, I want to leave you with one final provocative thought from the legendary investor Charlie Munger.
Oh, this is a good one.
He said, "Take ideas wherever they come from, but use your own brain to assemble them." We've given you the 5 languages. Munger reminds you that you are the dictionary.
That's brilliant.
If you found these connections helpful in understanding how these 5 foundational financial languages translate into a personal strategy, please make sure to like this deep dive and subscribe to the channel for more knowledge shortcuts. We look forward to connecting with you on the next deep dive.